Dear audience, warm welcome to the presentation of WHU's results of the CFA Institute Research Challenge on TeamViewer. TeamViewer is a German, globally operating software as a service company with a comprehensive product portfolio targeting a broad variety of different industries and markets. For the most part, however, TeamViewer focuses on providing services with cross-industry use cases. 4 out of 8 of TeamViewer's products currently do not target a specific industry, but are rather for general usage. In this category is also Xalion, one of the 3 acquisitions TeamViewer has made so far, with the other 2, Ubimax and Upskill, focusing on the augmented reality space. TeamViewer has been incredibly successful, particularly in recent years. Since 2018, TeamViewer has increased its quarterly revenues by 46%. This is largely due to TeamViewer's successful strategy, which relies on 3 core pillars. TeamViewer aims to expand its product portfolio continuously, to tackle the enterprise market, and to focus on new international markets. Finally, TeamViewer also constantly monitors potential M&A candidates. With Ubimax, it has made its first major acquisition in 2020. And although TeamViewer argues its focus on its organic growth, acquisitions seem to play an ever more important role, as the company has made 2 in 2021 already. Overall, we would like to issue a buy recommendation for TeamViewer with a target price of 46 euros and 60 cents. This is equal to an upside of over 20%. Our decision is based primarily on 3 reasons. TeamViewer's strong growth potential across many different software services, its untapped potential in many international markets, and its promising financial performance and strategic direction. That being said, I would like to hand it over to Philip.
Thanks. One reason for issuing a buy recommendation is that TeamViewer is operating in the rapidly growing SaaS industry. For different segments, we have projected compound annual growth rates in a range between 12 and 35%. Thereby, augmented reality stands out with a particularly high growth rate. Since, as we have already heard, TeamViewer has increased its AR exposure by acquisitions, we believe that the market has not yet fully incorporated this additional growth potential. Moreover, we expect that COVID-19 has fostered profound and long-lasting shifts toward digitalization across industries, providing a solid basis for revenue growth. Considering TeamViewer's geographical revenue split, we can see that currently only a minor share of sales result from APAC. However, TeamViewer has demonstrated that growth in APAC clearly outweighed that of other regions. Moreover, APAC offers the largest market in terms of overall size, growth, and spending on digital transformations. While we are aware that the competitive landscape and regulatory environment in APAC pose challenges for TeamViewer, we still believe that the growth potential in APAC is not yet fully captured in TeamViewer's valuation. To properly examine TeamViewer's competitive positioning, we distinguish 3 clusters. On the left, you can see TeamViewer's most similar peers in size and business activity. In this comparison, TeamViewer stands out by a comparatively high EBIT margin given expected revenue growth. In the middle, TeamViewer is compared to smaller, more specialized competitors. In this clustering, TeamViewer differentiates itself by relatively high revenue given still limited headcount. Finally, the right graph depicts TeamViewer and global SaaS providers. Although TeamViewer's size is certainly not comparable yet, past rapid sales growth indicate that the firm slowly catches up. To summarize on the industry assessment, we conclude that TeamViewer is well positioned to capture attractive shares in rapidly growing markets, whereby particularly the growth potential of augmented reality, COVID-19, and APAC seem not yet fully captured in the valuation. And with that, I hand it over to Sufyan in the financial analysis.
Thanks, Philip. In terms of financials, we believe TeamViewer has a strong performance in the next 5 years, mainly driven by the high revenue growth, improved margins, as well as lower liquidity risk. Looking at revenues, we forecasted 22% CAGR, with even stronger growth in operating and free cash flow. This is mainly driven by the expansion in APAC and Americas, them being new markets with significant upside, as well as improvement in the capital structure. And a significant reduction in debt and subsequent interest payments is forecasted. For example, in 2019, the debt to equity ratio was over 6, which is forecasted to be less than 1 in 2021. Looking at the margins, the gross operating and net margins are all forecasted to improve. This is due to economies of scale, TeamViewer being a low marginal cost business model, as well as technological progress, with advances in AI and automation, improving efficiency without the extra personnel costs. And personnel costs are among the biggest cost buckets for TeamViewer. Looking at TeamViewer's net margin bridge, we forecast that the net margin will increase from 30% in 2020 to 37% in 2025. This is mainly driven by the improvements in SG&A. However, we see that R&D spend is forecasted to increase over the next years, and this is important for TeamViewer to stay competitive and keep on innovating. Finally, given the factors above, such as increasing margins, hence cash flow, as well as lower debt, we project lower liquidity risk with the current and cash ratio going above 1 by 2023. However, we have to keep in mind that TeamViewer, being a growth-oriented tech company, will reinvest the excess cash flows in M&A activities, among others, as it already has done with 2 major acquisitions so far this year. Due to this, the cash and current ratio will not go significantly above 2. And with this, I would hand over for the ESG part.
Thank you, Sufyan. To incorporate existing ESG research, we made use of the MSCI ESG ratings methodology to better understand and evaluate TeamViewer's ESG risks and opportunities. Also, we applied MSCI's ESG industry materiality map, which helps to identify and weigh key ESG issues within the application software industry. And by doing so, we concluded an overall score of 7.4 out of 10 for TeamViewer's ESG rating. This score categorizes TeamViewer as a company that is a leader in its industry in addressing challenging environmental, social, and governance criteria. Just to name 2 examples here, as mentioned on the slide. Looking at the environmental aspect, TeamViewer is operating on a carbon neutral level since 2018. On the other side, TeamViewer significantly lacks diversity on the supervisory board and the executive board due to a lack of female representation. In addition to that, TeamViewer has recently issued an ESG-related €300 million bond, thereby further incentivizing the firm to increase ESG efforts. And now Ananto continues with the valuation part.
Our target price of €46.6 was achieved through a weighted average of 2 valuation methodologies, the DCF and the comparable company analysis method, with the majority weightage of 80% being assigned to the DCF, as we believe that it is a more accurate measure of the true value of TeamViewer due to a lack of a truly suitable peer group. In the DCF valuation, we use both the perpetuity growth rate and the exit multiple method based on the EV/EBITDA trading multiple for the terminal value calculation. With regards to the other key DCF inputs, I'll discuss them in the following slide. For the comparable company analysis, we assign the EV/EBITDA forward multiple with majority weightage of 70%, as we feel it is the most relevant multiple because the software industry is a less capital-intensive business and the multiple has relatively limited exposure to accounting differences, which is an important factor considering our peer group. Regarding the key DCF inputs, the 3.91% perpetuity growth rate is based on the weighted average of the average inflation rate, the GDP growth rate of the various operating regions of TeamViewer, TeamViewer's expected industry growth rate, and a regression analysis forecasting the firm's long-term growth rate. TeamViewer's WACC of 7.69% was calculated using a cost of debt of 3.9% and cost of equity of 11.1% derived using the CAPM model. We also carried out a sensitivity analysis for the key DCF inputs, namely terminal growth rate and WACC, to see how the stock price changes based on these inputs. Finalizing the valuation, we conducted a Monte Carlo analysis to test our buyer recommendation to incorporate uncertainty. We did so by normally distributing the input variables, namely WACC and terminal growth rate. Our analysis showed that 68% of conducted simulations, the implied share price is above our buy recommendations. Hence, we conclude that our recommendation is reasonable. Next, Nicholas will continue with the investment risk and conclude our presentation.
Thank you, Ananta. When analyzing possible investment risk, we categorized 4 different risk classes: business and operating risk, market risk, regulatory risk, including governance risk and the ownership structure, and legal risk. We assessed that products and security threats, as well as industry competition pressures, are the most threatening risks
1 minute.
due to high probability of happening and significant potential impact. However, we believe that TeamViewer is well positioned to tackle these challenges and risks. And finally, summarizing our investment thesis, we once more want to emphasize TeamViewer's potential for acquisitions, growing exposure to AR, low risk in combination with strong ESG potential, and the lasting and profound impact of COVID on the markets and the firm. Hence, we believe the firm is undervalued, and we issue a buy recommendation for TeamViewer stock with a corresponding target price of €46.6. This represents an upside potential of 20% compared to the current price. Many thanks for your time and looking forward to your questions.
Thank you. Judges, at this time, please turn on your video. You can stay muted unless you are actively speaking. I will start time as soon as the judge utters the first word. Time will end at 10 minutes. Feel free to begin.
Hi, team. Thank you very much for the presentation. Quick question from me. Given the latest Manchester United deal, the company reduced their operating margin targets. And I can see on your slides, you're still using their old numbers. Can you walk me through whether that's really changed your views?
Sophie, and you're
You're
on
on
mute.
mute.
Yes, it was covered. Okay. So as you can see from the, I can show you many charts. If you look at the 2020 estimate for the operating cash flow in 2021 for free cash flow, the growth rate is much less than the previous years and the next years. And this is due to the 46 million euro Manchester United deal. If you see next on the margins as well, 2021, there's a significant dip in the net margin from 30% going to 25%. However, we feel that the revenue growth that will occur from the Man U deal, as well as the Formula F1 deal, will lead to increasing faster revenues, which will then allow the margins to recover to the stable rate of around in the north of 30% for net margin.
Maybe continuing on margin, what's driving their margin is so much higher than the peers, the international peers you highlighted, and is there downside to their margin as a result?
Mm-hmm. So two elements there, and Ananta can probably add on to the peer analysis. Well, the first is that TeamViewer doesn't necessarily have a very adequate peer group, and that's why we also underweight it in our valuation. And the other part is TeamViewer, as you can also see in one of the first slides, has cross use cases, which has a lot of network effects here. So 4 out of 8 cases have cross industry use cases. So these network effects really allow it to take the margins out. And another point is with their subscription model. So they switched from a perpetuity model to a subscription model, which means the customers are incentivized to keep on or keep being with TeamViewer while incorporating the new offerings and services that TeamViewer is offering, especially with the acquisitions of Talion, UbiMax, and Upscale.
So I'd like to add on. So one of the main benefits of the sponsorship deal is the improve in the branding image of TeamViewer. So with these improvements in branding image, the company believes that they will be able to gain a pricing power in the market and a premium positioning with this premium brand image. So that will definitely help improve their margins and by offering low cost solutions to their customers.
You mentioned 2 acquisitions recently. How successful or value additive or not do you think they were in terms of the company's prospects for the next few years?
Maybe I'll start and then my colleagues can add on to it. So what we really believe is that these companies are kind of a promise for the future. So they've been growing very promising in the past, and hence we believe that is also something you have to consider in our projections, that they will probably benefit from these acquisitions in the future, also because they are in a very interesting spaces, particularly augmented reality space, which is growing very drastically, which Philip maybe can add on to. So we believe particularly the industry and also the individual companies look very promising.
And just to comment there, the only acquisition where we can have some insight to how it turned out is the UbiMax one, which was in 2020. The rest are only a couple months old and in 2021. So how well they're integrated, it's still uncertain. And that's also kind of reflected in the stock price at the moment with recent volatilities.
I like to
according to TeamViewer's reports, the integration, though it was costly, the UbiMax one has already started to show benefits in the few months after the acquisition.
So
maybe I wanted.
Okay.
Sorry, Sophie, you can go first.
Okay, I'll go first. So in addition to this, even though there's uncertainty, like Sufyan mentioned at the end, it looks promising because recently in April 13th, they announced news that they are launching this TeamViewer Engage. So this new product that they're offering, this was only made possible because of the acquisition of the startup Xelon earlier this year. So this is a recent example of how quickly and how successfully the company is able to integrate their acquisition. So it looks promising for their other acquisitions as well.
It was the same point I wanted to make. Thank you.
Thank you.
So you mentioned that a lot of the growth in the past came from Asia Pacific, right? Do you expect that to continue? If not, then how do you expect the revenue growth to change over time within different regions?
I can kick it off. Sufyan, maybe move forward 2 slides to this. So currently we see a minor share of 13%, but the trend is clearly growing. You can see in the bottom right graph that the sales growth was highest in APAC, and we forecast the sales growth in APAC to continue based on the other metrics shown on the slide. So the GDP growth is on average highest, and also the absolute market size in terms of inhabitants, and also the global spending on digital transformation is largest. So these indicators give thoughtful evidence that we project also a positive growth rate in APAC, so that the revenue split will shift more towards an equal split between Americas, EMEA, and APAC in the long run.
And adding on to that as well, the company's intent is also clear. The average headcount of APAC has grown more than EMEA and Americas at over 60% from 2019 to 2020.
Can you justify or make a judgment on the difference between the terminal growth rate that you have used and the one being priced by the market? I believe it was 2.7%. Yeah. So why do you think the market in this case or in this scenario is expecting 2.74 versus what you are expecting in terms of terminal growth rate?
Maybe to kick it off again. So we will, based on this WHU, we estimate the market would be the market growth rate, that the market estimates a growth rate of 2.7%. However, this is like the average, and we just heard that the exposure to APAC is likely to increase, and in APAC we have a higher growth rate in the long run. So we expect that a higher share of the growth will be driven by APAC, and this is one argument for justifying our terminal growth rate that is above the 2.7%.
Thanks.
When you think about the year-on-year comps as we go into 2021, it will be very tough. How do you think the market will react to it? Because it will be probably very difficult for the company to grow at the same rate as it was going last year.
Mm-hmm. Just on the revenue growth itself, the markets, though, there's still uncertainty how it will progress in 2021. The company has actually bumped up their revenue targets to reach or 1 billion in revenues by 2023. So the company is quite optimistic that the acquisitions and growth will help them continue and sustain their growth in 2021 and forward. And that's evident from their projections. And I think the market will over time incorporate as the uncertainty from Xalion and the other acquisitions, upskills takes into place.
Can you talk a bit about the ownership structure and what changes you expect? Do you expect there to be more stock brought to the market?
Yeah, maybe let me take this one. So basically what has changed is that Permira, once the majority holder of equity holder of TeamViewer, is increasingly selling their equity stake, now having approximately 20% of the non-free floating shares. So they continuously kind of decrease their equity stake, although being still the single company with the highest stake in the company, and TeamViewer being. So what we see here is a clear trend already that they continuously kind of sell a part of their equity stake, and we expect this trend to continue further. And maybe one side note here would also be that they still maintain a high control over the company because because Oliver Steil, the CEO of TeamViewer, is a former Permira employee, and hence closely related to the company still. So that is kind of the relationship between these two, and we expect that this trend will continue.
So Sufyan, if you can go to slide 23. So then there we see that the free float share that we currently have is, like Dominic just mentioned, is likely to increase.
Time. Thank you, WHU, Otto Beisheim School of Management.